All right, folks. So before we talked about the Federal Reserve, and one of the things the Fed does is monetary policy. Now, this came up briefly in the last video, in the last presentation, but I want to look at it specifically this time around. And maybe doing this a little bit differently than what I've done with some of the other ones. So I got this little PowerPoint here, but I'll be writing on the PowerPoint at the same time as we go along, right? So we got monetary policy. Now, what is monetary policy? Well, monetary policy is the Federal Reserve using the money supply to influence the economy. All right, so that's my very basic definition. If you look at official definitions, they'll get a lot more complicated, but this is good enough for us. So the Federal Reserve, you remember, is the central bank of the United States. It's the bank of banks, the bank for banks, the bank of the United States federal government. And one of the things the Fed does is create and destroy money. So the money supply is not controlled by the federal government. The money supply is controlled by the Federal Reserve. And remember, the Fed is not part of the government. It is not owned by the government. It is not directly controlled by the government. All right? It's a privately owned, relatively independent entity. And it is the one that decides how much money is in circulation. Now, how much money is out there affects the economy, right? So if we put more money into circulation, what will occur is more spending takes place. Okay, and the reason for this is that when more money is in the money supply, so if we increase it, that means there's more money that builds up at banks that needs to be loaned out. Okay, now banks want to loan that money out, and if nobody's borrowing it and they've got excess, then what they will do is lower interest rates on that loanable funds, right? On the money to be loaned out. So they lower the interest rates just like any merchant would lower the price on something they have a surplus of. So a bank has a surplus of funds to loan out, and they'll lower the price on that, which means the interest rates. So they lower the interest rates on the loanable funds on their loans, which means that people are more likely to borrow that money. And if they're more likely to borrow money, what do with it? They spend it. Not only that, but at lower interest rates, people are not as likely to save their money. Why am I going to save my money at a lower interest rate? Instead, I'm going to spend my money instead of save it. Okay, so more money in circulation will lower interest rates, which will therefore create more spending. Okay, and if we take money away out of the money supply, it's the same thing, but in reverse. When there's less money out there, there's less money to be loaned out, so banks will raise the price on their loanable funds. They will raise the price on their loans, which means raising interest rates. As they raise interest rates, people are less likely to borrow money, which means they won't spend as much, and people will be more likely to save their money instead of spending it. Okay, so we will decrease the amount of spending that is out there. So monetary policy, the Fed will use the money supply to influence the economy. So more money in circulation means lower interest rates, which means more spending. And then less money in circulation means higher interest rates, which means less spending. So remember when we looked at fiscal policy was trying to modify people's spending behaviors in order to try to get them to spend more or less. So if the economy is bad, the old Keynesians, right, they look at this as being a matter of too little spending. So we got people to spend more. So this was where the government would either lower taxes or spend more money itself. Okay. Well, the Fed can come along and do its own thing, which is expanding the money supply, putting more money into circulation, which will lower interest rates and cause more spending. Okay? And then with fiscal policy, remember fiscal policy, government. So the government could do contractionary fiscal policy if there was too much spending and we're getting inflation, and it would either raise taxes or lower spending. Okay? Well, the Fed can do its thing, and what it can do, the Federal Reserve, is put less money in circulation or take money even out of circulation, which will raise interest rates and therefore cause less spending. Okay? Now, how is the Fed going to do this? Create and destroy money? Well, it's easy to look at things and be like, oh, well, print money. Well, I guess you could do that, right? Fed could create a whole bunch of money, but now it's got to get the money actually out there into circulation. I guess it could drop money out of helicopters, and that'd be awesome if you knew where the helicopters were going to be dropping the cash. But that's really inefficient. The Fed has much better ways of doing this, especially when you consider that most money in circulation is not actually in physical form. It exists digitally, right? So the tools of monetary policy, the Fed has three of them. The first tool is called the reserve requirement. And we're going to go into a little bit more detail about each one of these, but the first one is the reserve requirement. The second one is called the discount rate. And the third one is open market operations. Okay, reserve requirement, discount rate, and open market operations. So let's look at the reserve requirement first. The reserve requirement has to do with the fact that when banks loan out money, they create brand new money in the economy. Okay, this isn't strictly this little bullet point right here. This is strictly what the reserve requirement is. It's just kind of setting ourselves up here. When banks loan out money, they create money in the economy that did not exist previously. And got a little spreadsheet here. We're going to try to see how this works. Let's say somebody comes along and they deposit $1,000 into their bank account. Okay. Now, let's say that there is a 10% required reserve ratio that the Fed has for all banks. You see, when you put money into the bank will turn around and loan that money out. This is how banks make a profit. A bank is a business. It's there to make a profit. The way they do that is take the money that you deposit in it and will loan it out to somebody who wants to borrow it. In this way, they're the middleman in the financial system. So you've got money, you want to save it. In fact, you'd like it to make even more money. There are other people who want to borrow money. How do we connect those two? Well, instead of you having to go out and find people who want to borrow money and borrowers having to go out and find individuals who are willing to loan it, everybody goes to the bank. You put your money into the bank will then turn around and loan it out at interest. It will keep some of the profit for itself and will give you a little bit of that interest in return, like if it's a savings account. Okay? Now, banks, however, are not allowed to loan out all that money. A certain percentage of that money they have to keep on hand as either cash in their vault or in the Fed's vault, or in the form of just their accounts that they keep with the Fed. Okay, because banks have accounts at the Fed. Remember, the Fed is the bank for banks. So they can't loan out all the money. Why not? Well, because they want to make sure that banks can pay off whatever liabilities they have. So if a depositor comes down to the bank and wants to take out all their money, they need to make sure the bank actually has it. If it doesn't have that money, then what can occur is somebody says, oh, wait, no, my money, oh my goodness, what's going on here? They tell their friends, and all of a sudden everybody's coming down to the bank trying to get their money out at the same time, and that causes the bank to fail. This is called a bank run or a run on the bank. This is one of the problems that existed in the banking system previously to the creation of the Fed and other regulatory measures. So the Fed requires that banks must keep on hand a certain percentage of everything that is on deposit at that bank. All right, for most banks, it's about 10%. Okay, so this is what the reserve requirement is. The percentage of deposits that the bank must keep on hand, cannot loan out. So in our scenario here, somebody came along and deposited $1,000 at their bank. There's a 10% reserve requirement. So that means that the bank must keep on hand 10% of that $1,000 and may not loan it out. Well, 10% of $1,000 is $100. Okay, so the bank must keep $100 and cannot loan that out. That leaves another $900 that we call excess reserves. Excess reserves is money that can be loaned out by the bank but has not yet been loaned out. So let's say somebody comes along and borrows that $900 for whatever reason. That $900 in excess reserves turns into a $900 loan. Boom! We just created new money. Did you feel the magic? Now, this seems really weird, but when that money got borrowed by somebody else, that was creating brand new money in the economy that didn't exist before. Okay? So that $900, let's say I came down, I borrowed the $900. I have $900 in my pocket. I can spend however it is I want. And the original $1,000 is still in the bank. That's still there. Whoever deposited that money can still go down to their bank and withdraw the entire $1,000, even though I borrowed $900 of that, and I can go around and spend it. This is real money, and this is real money, even though we just created this $900 out of the original $1,000. I know this seems weird, but this is how the system operates. This is called fractional reserve banking. And the goes even further. Let's say that I spend the money on something or other. Now somebody else has the $900. What do? Let's say they go down to the bank and deposit the $900 in their bank. Well, there's still a 10% reserve requirement. That means the bank must keep on hand 10% of that, or $90, which leaves $810 in excess reserves. So let's say somebody comes along and borrows that money. Boom! Another $810 in brand new money was created out of this. So in just 2 steps here, we have created $1,710. Right? And then the cycle continues, $810, somebody redeposits in their bank, 10% reserve requirement, $81 in required reserves cannot be loaned out, $729 in excess reserves that may be loaned out. When it does get loaned out, another $729 in new money was created in the banking system, etc. All right, now you'll notice we create more money at each step of the cycle, but it's less and less at each step. If you want to know how to get shortchange it here, or get a shortcut to figure out how much money is created overall, you don't need to know this, I'm just showing it to you. We would use the money multiplier, which is equal to 1 over the required reserve ratio. In this case, it is 1 over 10%, or 0.1, right? Because the 10% required reserve ratio is 10%, which is 0.1. So 1 divided by 0.1 is 10. That's the money multiplier, is 10. You would take 10 times the initial excess reserves of $900. That's what that was. So 10 times 900 would give us $9,000. I don't know why it's randomly bolding to some things and not others, but basically, once the cycle played itself all the way out, all this money getting borrowed and redeposited in the banking system, we would create up to $9,000 new dollars in the money supply that did not exist previously, all from the original $1,000 deposit up here. All right? And so this is how the reserve requirement operates. So let's say we're going to go down here. Monetary policy. We can do expansionary monetary policy. We can do contractionary monetary policy. This goes along with the fiscal policy. Expansionary monetary policy you do when in recession. So the economy is not doing well, you would expect expansionary monetary policy. Okay? You want to lower interest rates and therefore cause more spending. And the way you do this is expand the money supply. So it just goes along with the word, right? Expansionary, expand the money supply. So with the tools that we had, so the first one is the reserve requirement. The Fed would lower the required reserve ratio. Okay, lower the required reserve ratio. Why would they do this? Well, if this ratio is lower, that means banks don't have to keep as much and they can loan out more money. The more money they can loan out, the more money will be created in the money system and the money supply. All right? And then over here, contractionary monetary policy, again, it goes along with fiscal fiscal policy. You would do this when the economy is doing too well and causing inflation. So people are buying because they're spending, not enough stuff to buy. We want them to spend less. So in this case, we would contract the money supply, create less money. So here we would, or the Fed would raise the required reserve ratio. Here I'm going to take out this line right here so things remain symmetrical. I'm like that. So raise required reserve ratio. All right. So that's what the reserve requirement would be, right? So if we raise this percentage, that means the banks must keep on hand a bigger amount of money, cannot loan out as much, and therefore you have less money being created. For example, let's say we raise this to 20%. Well, now instead of loaning out $900, they can only loan out $800. And it would also change the money multiplier. The money multiplier, instead of it being 10, would be just 5. Okay? Let's see here. Let's go back over here. So that's the second one, or excuse me, the first one is the reserve requirement. The second one is called the discount rate. And the discount rate is the interest rate at which banks borrow money from the Fed. Okay, the Fed is the lender of last resort. If a bank is in trouble, it can borrow money from other banks. In fact, that reserve requirement, that 10% requirement, banks have to report that they have met it by the close of business every single day. But it might be during the normal course of business. Let's say they loaned out more money than they expected, or somebody comes along and takes a lot of money out of their account. So it could be that a bank doesn't have enough money to meet the requirement. But you also have other banks that have more than what they need to meet the requirement. So the bank that doesn't have enough will borrow money from the bank that has too much. They will borrow it overnight at what's called the federal funds rate and then pay it back the next morning. You actually have billions of dollars that move between banks on a daily basis for this purpose. But if a bank can't borrow money from another bank, it can always borrow money from the Fed. Okay, the Fed is the lender of last resort. It doesn't want banks crashing and burning. So this is especially important if you're in a financial crisis. Okay, so the discount rate is the interest rate at which banks borrow money from the Fed. If we're doing expansionary policy, the Fed will lower the discount rate. Okay, that makes it easier to borrow money from the Fed, which means more reserves build up, which means the banks will loan out more money. And if we're doing contractionary policy, the Fed will raise the discount rate. Okay, that means the banks can't borrow money from the Fed as easily, less reserves build up at the bank, which means they don't loan out as much, not as much is created. All right, so we got reserve requirement, discount rate. Now the third one is the big one. Open market operations. This is the main tool the Fed uses. And this is when the Federal Reserve buys and sells U.S. government bonds on the bond market. So these government bonds, right, the federal government will borrow money by selling bonds. We've talked about this briefly in the past. If somebody buys the bonds, they're loaning the federal government money. Well, what the Fed will do is go onto the bond market and buy these bonds or sell bonds to individuals, right? Individuals or institutions or banks, right? It's slightly more complicated than that, but basically this is what will happen, all right? So this is how the Fed will create and destroy money. Now, if the Fed wants to make the money supply bigger, it will buy bonds. If it wants to make the money supply smaller, it will sell bonds. Okay, the Fed will. So easy to remember, right? Buy bigger, sell smaller. Money supply bigger, buy bonds. This is what the Fed will do. Money supply smaller, the Fed will sell bonds. All right, BBSS. Now, what's going on here is the Fed, if they want to make the money supply bigger, they will go onto the bond market and they will buy bonds from somewhere else. So let's say that I'm the Federal Reserve and there are 20 banks out there. All right, and so I buy bonds from those banks. So now I get the bonds. What did I pay the banks with? Well, I paid them money for those bonds. Where did I get the money from? Poof, nowhere. Out of my magic bank account. I'm the Fed. I create money. It's slightly more, no, not too much more complicated than just adding some numbers to their bank account they have with me. So now the banks have the money. The money is out there with the banks. And what can the banks do with that money? They can loan it out and go through that required reserve process, right, that we had on the spreadsheet. This is what it'll do. They don't have to print money. Instead, they will create money out of basically nothing and put it out there into circulation by paying the banks for their bonds with that brand new money that was created. Okay? And if the Fed wants to create less money or destroy money, what it will do is sell bonds. So again, I'm the Fed. I'm holding on to some bonds. Let's say I sell those bonds out there to those banks. Those banks pay me money for the bonds that I sold them. What do I do with that money? Poof, it ceases to exist. I put it back in my magic bank account. That money no longer exists anywhere in circulation. It doesn't exist at all, right? I'm the Fed. I create and destroy money. Now, if you think this is a little bit weird, well, if you print money, where did the money come from? It came from nowhere, right? You just print, stuff on this paper and whatnot and called it money, and now it's brought to existence out of nothing. And we could burn money, and, well, what happened to the money then? Well, we literally destroyed it, right? Just poof in a literal sense. So when the Fed is doing this is a much more efficient way through open market operations, buying and selling bonds, much more efficient and much faster. The Fed can easily create and destroy money in the amounts of billions of dollars in a day through open market operations. All right, which is far faster and more efficient than trying to print money and get it out there to the banks and distribute it that way, or destroying money by collecting it, going through that trouble of collecting it, and then shredding it or burning it or what have you. They shred it, actually, is what they do. You can get shred money from Fed gift shops. Okay, so monetary policy here, expansionary. If the Fed wants to make the money supply bigger, remember, what will it do? It will buy bonds on the bond market and open market operations. For a contractionary monetary policy, what will the Fed do? It wants to make the money supply smaller, so it will sell bonds on the bond market. All right? So these are our tools of monetary policy, right? Tools of monetary policy: reserve requirement, discount rate, open market operations. Reserve requirement is the percentage banks have to keep on hand. So doing expansionary, they'll lower that, which means banks can loan out more money and therefore create more money. If the banks can't borrow money from the Fed, they can borrow it, or excuse me, from other banks, they can borrow from the Fed at the discount rate. And so the Fed can lower the discount rate in order to create more money, expansionary monetary policy. And then finally, on the bond market, the Fed can buy bonds, okay, which makes the money supply bigger, which is expanding the money supply. And over here, contractionary monetary policy, the Fed wants to make the money supply smaller, which will raise interest rates and create less spending. So what will it do? It will, here in the reserve requirement, all right, it will raise the required reserve ratio, which means banks can't loan out as much, which means they create less money. It can raise the discount rate, which means, again, less money is created. And finally, it will sell bonds, which will therefore take money out of circulation, okay, and therefore contract the money supply. Okay, so basic monetary policy in a nutshell, along with the various tools and the methods by which the Fed does it.